When purchasing a house subject to, should I be targeting short-term loans? So if you're purchasing a house subject to, then you shouldn't be targeting any loans at all, because subject to is subject to the mortgage in hand. So you should refinance, I think, as quickly as possible. But if you are buying a property subject to, then the mortgage is in place. Presumably the lender is fine with the property being purchased subject to the mortgage. So they're not in term and in fear. You shouldn't be in fear of them calling it anytime soon, which means you have the afforded opportunity of stabilizing the property before you look for finance. So if it's a true subject to deal, then I don't see the importance of short-term financing, because short-term financing is just used to kind of bridge the moments from having an unstabilized property that needs work, that needs to get rented out. And the short-term financing just serves as financing in those moments. But once you get the property rented out, and properly seasoned, then you should be looking for long-term financing. So if you're buying a property subject to, then keep that existing mortgage in place. Allow that to be that bridge financing. Get the property stabilized, make all the appropriate repairs, increase the rent, and then go out once it's stable and get a mortgage in your name. I, for one, personally am not a fan of subject to mortgages, because I don't, outside of it being a fantastic deal for the investor that's just getting started, that doesn't want to put their own capital or doesn't have their own capital to put into a deal, I don't think that subject to mortgage or subject to purchases are generally a win-win relationship or win-win transaction, because the sellers, the ones that have the existing mortgage, that are giving over, for all intents and purposes, the property to you, but their mortgage is the one that is underlying. The mortgage company is not going to amend or endorse their mortgage and add you to that. So all of the exposure, all of the liability falls on the sellers of the property. If the deed transfers, then I guess the liability is shifted between the seller to include both the seller and the lender. But at the end of the day, you might be helping the seller out of a situation, out of a loan that they can no longer afford, out of a house that they can't afford to make the repairs to. But if you had the ability to just buy the property outright, get rid of that existing mortgage, and free the seller from any additional exposure, then I think that is a better, less sticky transaction than the subject to. So I'm not completely against a subject to, but it has to be a really solid relationship. Otherwise, if you just buy this property subject to, I mean, the exposure's on the seller, so you could run that place into the ground further and destroy their credit and dig them into a deeper hole of being able to not get out from under that property. So obviously there's an element that's inherent with most business transactions of you just being a good person that sticks up to your word. And if you are in fact that, then even though on paper they have exposure, they don't have exposure in reality. But scaling subject to purchases becomes increasingly difficult, because the relationship aspect, to where they're comfortable with you and you're comfortable with them, that's got to be there. And relationships are really hard to scale.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.